So in the last video, we left off here. Earnings per share. Alright, I wanted to go on, but I decided to leave that for a different video. Okay, now actually using these two matrices, I can further derive a ratio. Right? What is a ratio? A ratio is basically, in simple mathematical terms, a ratio is basically x against y. Right? And to get x against y, you basically take x divided by y. Right? Then, and this value will be the ratio. Alright, this is really basic primary school math. Okay? Now, if you look at this, I can also derive a ratio. And that ratio is called price to earnings ratio. Okay? Which is also known as a PE ratio. Alright, which is also known as a PE ratio. Now, a PE ratio basically is taking price per share divided by earnings per share. Okay? And this would give us what is commonly called the price to earnings ratio. Okay, so for example, going back to the example that I stated in the last video, let's say that the EPS now is 1. Okay, so the EPS is 1 USD per share. Okay, because the net earnings is 100,000. There's 100,000 outstanding shares in the market, so 100,000 divided by 100,000 gives you 1. Alright, now if it's 1 USD per share and the current price of the share in the market, for example, let's say the share price now is 5. Okay, and we know that the earnings per share is 1. So what will be the PE ratio? The PE ratio is 5 divided by 1, which will give you 5. So the PE ratio now is 5. Alright, now when the PE ratio is more than 1, it means that the company is overvalued. If the PE ratio is below 1, it means that the company is undervalued. Alright, this is basically what it means. Alright. If PE ratio is more than 1, okay, it means that the company is overvalued. Alright, if PE ratio is less than 1, it means that the company is undervalued. Alright, very simple, very straightforward. Super straightforward, super simple. Alright, now again, okay, this is too simple. You cannot just look at one ratio and say, okay, I'm just going to buy the stocks that are undervalued. I'm not going to buy the stocks that are overvalued. Now, people look at PE ratio with a few different lenses. The first lens is obviously what I just said. If PE ratio is more than 1, it means that the company is overvalued, meaning that you are not getting a bang for your buck when you buy the shares. Okay? Because you are putting in more than what the company is churning. You are putting in more dollars than the amount of dollars that the company is generating. Now that is one way to look at PE ratio and EPS. The second way to look at PE ratio and EPS, which is coming from the other side of the fence, is that the company has potential. Okay, you are putting in more dollars than the company, but the company has a huge room there to rise up to the amount of dollars that you are putting into the company as of now. And when that company rises up to that extent, okay, your valuation will also go up, because this gap between the amount of dollars you're putting in and the amount of dollars that the company is generating will always stay there. In fact, for a SaaS company like mine, software as a service, this gap might be expected to widen as the number of users get more and more. Alright, because the company, like I said in the previous video, is also valued on data. That's why PE ratio is always very high for tech companies. There's a reason why. Okay, it's always very high for tech companies because tech companies, especially software as a service company, they gather a lot of user data like Facebook, LinkedIn, Instagram, YouTube, your social media platforms, maybe your other like Salesforce, maybe Grab, Uber, Gojek, Food Panda, Deliveroo. Okay, I can name them all, but you know what I'm talking about. These are all considered software as a service companies. All of these platforms gather a lot of user data. Alright, and that user data is priced highly because that data can be monetized in the 1,001 ways. Okay, when I go to your shop, let's say you sell candy, and I go to your shop and I buy candy, you don't have any data on me. Alright, I buy the candy, I'm off. The only data you have is how many pieces of candy you sold for the day. But when I register as a member on your platform, I constantly use your app, your software, your service, whatever it is. You collect data on what I like. Okay, and I can monetize that data. That's number one. Number two is I can use that data to sell other things to you. So data is priced separately. So therefore, for tech companies, the P ratio is always very big. Now, for tech companies that don't focus on gathering data, but they focus on future tech, like for example, Tesla. Now, the P ratio is also huge because people are pricing in the future impact that all these technological pieces will have on the world. For example, alright, Tesla, they build rockets that fly to space and fly back. They build rockets that can fly up and then land vertically down. Now, the P ratio is huge for Tesla because investors think that riding in rockets to space and coming back down vertically will be something that is a norm in the future. So although the rocket hasn't started getting passengers per se, they believe that the rocket is the way forward. So they are pricing in that already. They are pricing in that future 10 years, 20 years, 30 years down the road into the price of the stock right now. Okay? So I hope you understand PE ratio a bit better. I hope you understand how the stock market works a bit better. Alright, with this video, with this few videos that I actually shot out. Okay, so with that, I end my video right here. It's been about 8 minutes. I thank you for your attention. On behalf of Rubik's, please download the mobile app. Alright, join the Power Giver movement as well. Join the Power Giver movement. Now, if you don't know what's that, head over to the Power Giver video series. Okay, if you have knowledge, I want you to propagate it. I want you to go out there and spread your knowledge like wildfire. Alright, thank you, and thank you.